Hi, and welcome to the Forex Academy Fundamentals training. Well, this training consists of several videos and its main objective is to introduce you to the real-world events that shape and influence the action on the Forex markets. All videos in this course can be recognized by the logo that has appeared in the top right-hand side of your screen. Let me start by briefly outlining this course so you can skip what you already know and cherry-pick your areas of interest. In the second part of this video, we'll kick off with a quick and easy economics lesson. Nothing fancy, but just enough to refresh those concepts that are relevant to the Forex market. We'll also introduce some handy tips that will help you trade the Forex economic events. In the second installment of the series, we'll take a look at the economic events that shape and influence the USD currency pairs. Seeing as the US dollar is still the world's reserve currency and that all of the major currency pairs are doing something with the greenback, these events are by far the most important to keep an eye on. The third part of this series will take a closer look at the European Union and its organization. This background information is necessary to be able to correctly assess the important indicators coming out of the Eurozone, the most important of which are duly covered later on in that video. Part 4 will deal with the Asian Pacific region and the Japanese economic indicators. Very important if you want to get into the USD-Yen trades. Part 5 will take a brief look at the British economy, and Part 6 will close this introductory series by taking an up-close look at commodities, such as oil, silver and gold, and how their trade influences the Forex market and specific currency pairs. Alright, so economics. Basically, what economics means is that all human transactions can be valued in terms of money. Whilst the jury is still out on that statement, it can be said that your Saturday afternoon supermarket purchase is part of a huge system of money transactions all over the world. One of the basic tenets is that money flows everywhere are all interconnected. That may be so, but not all money is created equal. Generally speaking, every country has its own form of money. The Americans have the dollar, the English use their pounds, and the Germans have the Reichsmark. Euro. If an American wants to buy, say, a German car, then he has to pay euros to get it. In order to get euros, he needs to persuade someone to take his dollars and give him euros in return. In short, imports and exports of goods, services and capital creates an additional market, a market for trading currencies. As you may have already heard, this is the biggest market on earth. It's also called Forex. Basically, you might view any currency pair as an expression of the relationship between two economies. Now, there are lots of things that influence the exchange rate between two currencies. Sentiment is a big factor. Recently, we've witnessed the collapse of a number of major banks due to risky business by those banks in America. American banks have been impacted the hardest by far, and the American government has pledged to spend more than any other government to rescue these banks. Yet, the American currency has become stronger against every other currency. It has gained over 30% against the euro, which happens to be the second largest traded currency in the world. This seems counterintuitive. The Americans create a destabilizing event, suffer from it the worst, and throw the most money at it to repair it. Yet their currency becomes stronger. Why? Well, this is a clear example of sentiment. The dollar being the world reserve currency, which means that the dollar is basically the currency that every other currency is measured against, it is considered a safe haven in times of crisis, war or disaster. So while you would expect the dollar to spiral ever faster toward a second-rate status after such an event, the currency only became stronger. Because lots of companies and banks let go of their euros, yens and pounds, to convert to dollars, the safe haven. While this, of course, is a major example, sentiment influences the market on a daily basis and is very tough to measure. You really need to get acquainted with the market to see its effects. You might view sentiment as a fog that descends over the market and disguises the real values. It's like looking through love goggles. Thankfully, there are some clear signs that you can hold on to gauge the real strength of an economy. Outside of grand current events, such as wars, civil unrest, famines, droughts, natural disasters or plagues, any economy has dials and gauges that tell the observer how the economy is performing and might in the near future perform. These gauges are called economic events, and they are watched very closely by all serious Forex traders. Almost always will there be some expectation about the outcome of these indicators. And almost always will this expectation be factored into the market already. If, therefore, the actual numbers don't match with the expectations, which often happens, markets react, sometimes violently. A hapless Forex trader who is just looking at his charts and trying to range trade an apparently peaceful currency pair could be in for a nasty surprise. It's best to stay clear of markets that are waiting for an indicator to come out. As the most action happens between 15 minutes and 90 minutes of the event's issue, it's best also to wait and see what the market thinks about it, and then ride the wave until there is no more wave to ride. Remember, anytime there's upheaval, there's money to be made. Because we Forex traders are trading changes in a relationship, and relationships change all the time, there is never a bad time to get into the market, as long as you know what you're doing. Next lesson, we'll look into the major economic events for the USD. Want to know more about the economics behind the Forex thing? Feel free to visit forexacademy101.com for some in-depth articles about the market, its players and its contexts.